Yeah, so it has been a wild, wild week. I mean, you go back to the Fed decision, we had that monster short squeezed rally after the Fed came out with that 50 basis point hike. We had Jerome Powell coming out with the press conference. He seemed to be not so super hawkish, but very hawkish, which was just a slightly better than the market anticipated. The market seemed to kind of breathe a sigh of relief. And then that all went out the window the next day. And I think the kicker for the next day was the productivity numbers. So the economic numbers came out with productivity numbers much weaker. And what we ended up seeing is that, basically productivity slipping with high inflation is a recipe for stagflation. I think the market is really starting to get freaked out about that. So we've gone down heavily. We saw 5% on the NASDAQ yesterday. Today, another down day. And again, it could stretch into next week. So I think that, again, we see rates continuing to go up. The 10-year is now, I think, around 3.15, which is a remarkable move. And again, it's going to slow the economy. There's no doubt about it. I think by the end of this year, early next year, we do have a recession on our hands.
Now, you mentioned that productivity number, the worker output, down 7.5%. So it was kind of striking that on Wednesday we saw the rally in the stock market and then lost all its gains. This Dow was down 1,000 points. Now on Thursday, so do you think it was that number that caused that correction, or what was it exactly that caused that 1,000-point drop in the Dow?
Yeah, so I think it was just slightly, like maybe 25% of that number, kind of a realization that, hey, there may be an issue where growth is starting to slip and you still have high inflation. And then the other side of it, I think, was that the market initially breathed a sigh of relief after it was only 50 basis points and kind of it would stay the course. But then the market was like, but wait a minute, staying the course means another 50 and then another 50. And they have to continue doing this to get inflation under control. And that realization means that, again, the economy is going to have to slow. I mean, that's what rate hikes do. It sucks money out of the system, and it's going to slow dramatically. And the market doesn't have a lot of confidence in the Fed after they waited too long to kind of hike rates. And then if you go back historically, even back in 2008, 2009, the Fed was on the sidelines for way too long when things were collapsing before finally stepping in. So the Fed does not have a good track record of kind of doing things just right. They always overdo one way or the other. And the market is now definitely worried that they're going to overdo rate hikes and cause us to be in recession. And then how do they get us out of recession, right? They can't print money if inflation is still even 5%. So again, that puts us in another conundrum.
Now, when it comes to how the Fed is going to react to this, it seems like, I mean, obviously they don't want a downturn in the stock market, but will they just keep going with these half-point rate hikes?
Yeah, so I think the Fed is okay with a slow and steady kind of down move in the stock market. They don't like these big moves. Like 5% is huge. I mean, for people, it gives them shock. I mean, the average American looking at their 401k, it can give you a shock, and then you say, hey, I'm not going to spend anymore. And the Fed wants you to slow your spending. So that the supply chain issue kind of corrects itself, but they don't want you to stop spending totally. And so I think this is where it is where they are okay with the stock market coming in. They know it was kind of overdone, but they just don't want it to fall off a cliff, which it's starting to do because the stock market and investors are starting to worry about a recession and stagflation.
Now, we also saw the dollar hit a 20-year high. Now, what kind of impact do you think this will have on the markets?
Yeah, I mean, the dollar being strong, it has been one heck of a run. And if I can let me show my chart here so we can kind of gauge what the charts are showing us. So, I mean, it has been a meteoric run in the dollar. We've seen the dollar versus the yen just have this crazy move as well. The one thing I will say is that the dollar has hit resistance going back to this high, going back to 2017. So there is a chance that the dollar could be stalling here. You want to see a pullback in the dollar. Again, the biggest issue is, and this, by the way, shows how broken the system is, when you have the bond market making moves like it's doing, when the dollar is making moves like it's doing, when the stock market is dropping 5% in a day like it's doing, it's telling you something is broken here. And this is where catastrophic events can come out. I mean, if you go back to 2008, the financial crisis where banks failed, things like this started to happen where these crazy moves occurred, and then it put situations in play that should not ever have been in play. So, we have to be very vigilant. I'm sure the Fed is monitoring the situation very, very closely. But the dollar itself, major move. It is into resistance. It's stalled here. If we zoom in, you can see it's kind of has stalled there. But my concern is this making a bull flag? This kind of is consolidation that could break out. So that's going to be even more an issue. Also, a strong dollar hurts companies, like the earnings from companies like IBM as well. And that also can be hurtful to the stock market because if it brings in multiples because of that, that could be an issue.
Now, you mentioned how this could be catastrophic for the markets. Can you share some specifics of what you think might happen in this case?
I mean, the biggest issue is, do we start to get into liquidity? Does liquidity dry up? And we've seen that occur in the past where all of a sudden, you don't have buyers of bonds, or you don't have buyers of various different things. And then the bottom falls out and you could have a very big collapse in things, even like the stock market. You can have a flash crash type scenario on a big down day. When we were down 5% on Thursday, it was one of those scenarios where if the algos had just stepped back because the selling got too intense, there was no buyers underneath, and you could have seen a very, very big kind of crash scenario. So, these type of markets are markets where you have to be very, very careful. I do think there are opportunities out there on levels, like if you look at some of the tech stocks that are down 80% or more, they could get bounces, but I wouldn't be marrying them at this point for the longer term, because I still think the NASDAQ 100 has another probably 20% downside before it finds any sort of real level of stabilization.
And you've mentioned that the stock market could fall much further. Can you show us the charts of that? For example, the S&P and what you're looking for kind of on a technical level going forward?
Yeah, absolutely. So I think that's really important to kind of gauge it too, because we're still at such elevated levels due to the pricing and the liquidity that was injected into the system due to COVID. And here, if we zoom in on this chart, so here you could see this is where we are, and we're really in the scheme of things not that far off of the all-time highs. You're talking about 479, we're at 408 now, 409. So we're down about 70 points on the spiders, which again is shy of 20%. But then if you zoom out on this chart, here's your longer term trend. This is just a normal trend of expansion, right? This isn't even factoring into recession, the potential for recession. Here was your COVID collapse, and then here was the market on steroids on that, all that crazy liquidity pumped into the system. So we haven't even come back into the normal growth range of the market, let alone if a recession does hit later in the year that probably pushes us maybe back to the COVID lows. So again, it's a market where at the at the very minimum, I think we're going back to like this pre-COVID high, which puts us down another, $60, $70 on the SPY. In the worst case, if you do get a recession end of year, I think we're retesting the COVID lows down at 220 on the spiders.
That would be quite a drop from where we are today.
Yeah, it would be. And you have to remember is that, the inflation issue, which, by the way, yes, a lot of it is supply chain, but it's not all supply chain. And that's going to be the issue, is that you have this scenario where wages have had, I think there's a stat where it's like 1.5 jobs to 2 jobs for every one person out there that's unemployed. So there, even if everyone got employed, there's still more jobs. And what that's doing is it's causing these companies to have to pay more money, which eventually has to be passed down to the consumer, right? If you're paying all your employees double, well, you can't go out of business. You can't lose money by paying them double. So you have to raise prices for your widgets or whatever it may be. And so that is going to be passed along. That's not a supply chain issue right now versus what's going on with Russia invading or China's lockdowns. And so again, inflation is not going away for a long time. I think 5-10 years where you're going to have 4 to 5, maybe 6% continual inflation. And that's going to make it almost impossible for the Fed to come out and bail us out of the next catastrophe, right? How does the Fed come out and print another $10 trillion when we already have inflation at 5%? They probably can't do that. And then the question is, well, what do they do? And again, all right, you lower interest rates a little bit, but again, that's pushing more liquidity into the system, which will increase inflation. So there is a big issue here with there's no real major bullets that the Fed has in their gun anymore to fight the next downturn. And that's what's so scary. You don't know how bad it could get if the Fed has no way to combat the next recession.
Now, if we can turn to how precious metals are reacting to all this, we have seen a downturn, which I guess is a bit surprising because it seems like precious metals should be thriving in this kind of stagflation environment. But your take?
Yeah, so I think what you're getting right now is exactly what should happen in regards to at least the gold chart, the silver chart as well, and we'll go into that in just a minute. But basically what you had is you had this breakout on gold, right? You had this trend line here, right here, and then this secondary trend line. And right here is where you broke out. And when you broke out, it happened to coincide with the invasion of Ukraine. A run for safety occurred where you saw gold shoot up right into what a technical trader would call a double top, right? So you went into resistance. What do you get from resistance? Usually a pullback, and that's what you're doing here. So again, for me, I still think there could be a little bit more downside on gold to this 18 and a quarter-ish level, but ultimately this is a very normal check back to the breakout level. All right, so when charts break out, they tend to retrace to what we call the scene of the crime, which is right in this level. Once that happens, you should see the next leg up in gold occur where it will take out this 2075 high and really start to catapult higher. And I still think it wouldn't shock me to see 2,400 gold by year end. And again, that's December 31st. Would not shock me to see that. Now on silver, this is a little bit more of an interesting scenario. Silver had a breakout here, but it's come back below that level here, and it's kind of settled into where it was trading. Now you might say, well, what's the difference here? Well, the difference is that as people start worrying about a recession again, or a recession in the U.S. economy, or maybe even the global economy, we have to remember that not only does silver act as a precious metal safety trade, but it's also an industrial metal. So that's the issue here, is you've seen this pretty sharp sell-off on silver because people are now saying, wait a minute, maybe the world won't need as much silver supply because there's a slowdown in buying due to a potential global recession. So I still think silver is a no-brainer buy down here. In fact, I'm long silver at these levels down here, but I do think that explains why silver has had a much sharper pullback than gold in the near term.
It seems like with silver, as long as it does hold above that $21 level, we're probably not going to go lower, but your take on that?
Yeah, so this is a really, really important level, right around $22 on silver. If it does break that, then you have to start looking at this as your next level right here, right? So you could head down maybe as low as 19 or so. But right now, this is a definite line in the sand on silver, and you'd prefer, especially me being long, I'd prefer to see it actually hold this level and then start to make that next move up. I think the key is, time frame wise, right? So if you're an investor who's very short term, well then, yeah, there's some risk here where maybe in the short term it goes down to 19 if it breaks this level. If you're someone who's saying, I'm holding my silver for 3 years, 5 years out, the money printing, as much as I think the Fed is in a box, I think that when push comes to shove, and you have unemployment starting to spike to 5, 7, 10%, 12%, 15%, eventually they're going to go back to what they know best, which is money printing. And so again, that's inflationary, especially if inflation doesn't go below 5% for many years. I think the ultimate angle of silver is higher. It's just, again, short term versus long term.
Now, you mentioned how silver is an industrial metal. For that reason, do you see it outperforming inflation? Because it seems like if we'd see a recession, that might be bearish for silver on that fundamental basis. So your perspective on that?
Yeah, so I mean, that's a great point of how if there's a lack of demand, then it's going to offset its ability to outperform inflation, which right now is 8.5% per year. So I think that is a valid near-term kind of factor. I do think ultimately, again, that you will see, I mean, we've seen silver in this long-term consolidation pattern, and you could argue that it's lagging inflation and needs to play catch up. And I do think at some point it will. Right now, the market seems to be focused on, other areas. I mean, for the most part, it was with big cap tech. Now that's starting to slip. I do think as people get more and more shy from investing in certain stocks, big cap tech and so forth, I do think they're going to start to look for the metals, and the metals will be the next big performer. So if you go back to, in fact, let me look at the chart here, and let's go back to a little bit further back in time. We'll go to the weekly chart. You had this kind of crazy move up in silver back in, really, it was like '09. It started at the base in '08, and then it went all the way into '09. And that's kind of what I see happening here is if we get into this kind of recessionary period, end of year, I think you bottom out on silver, and then it has this monstrous run as people start saying, okay, the recession's here. I can't be in stocks. Real estate is collapsing due to high interest rates. People can't afford houses at 5-6%, on the 30-year mortgage. And so now where do you put your money? And really, there's not many places to go. You can go in gold or you can go in another metal. And silver will take some of that absolutely as kind of a way to avoid the total inflation and just the lack of no other place to put your money.
One of the other markets that we often talk about is cryptocurrency. Now, what I just keep thinking about is how many of my friends are interested in cryptocurrency. And I even was at the grocery store and there's a magazine about cryptocurrency. And it's just like, well, what's going on right now? It seems so popular right now. Should we be concerned?
So anytime this is the way a lot of people think the crypto bottom is close to being in. What you just described tells me it's not, right? Crypto bottoms, just like stock market bottoms, are based off psychology. And the way bottoms are put in is when everyone is too scared to even think about buying it. We saw that in 2018 and into 19, where no one wanted to touch it. I still remember vividly, in 2017 when it was hitting those all-time highs of like 20,000. CNBC had the ticker of Bitcoin, right at the bottom of their screen every single day. By mid-2018, you couldn't even find it. It wasn't even discussed on CNBC. Those are indicators that you've gotten close to a bottom. When you talk to people and they're like, oh my goodness, I don't even know if Bitcoin or crypto will survive, that's the time you want to go in. So just clearly on the charts too, you have to look at this chart and you can see this bearish flag. And I've talked about this for months, that this was a bearish flag pattern. And you can clearly see it started to break to the downside now. So your next stopping point for me of major support will be this 29-ish thousand, which was your low from 2021. And if it breaks that, then I think you're headed towards 20,000, which is the 2017 high. So I'm still in the camp, as much as I love Bitcoin long term, and I really think it is going to become the digital gold. We have to remember there's 4-year cycles. There's no lengthening. People used to talk about this lengthening of cycles. Nonsense. That hasn't happened at all. It's still stuck in the 4-year cycle from 2017 to 2021. And if we look at cycles, Bitcoin has tended to make an 80 to 85% correction in each of its down cycles, right? So you have to think that maybe even 20,000 is too high of a target. My hope of it holding or getting around 20,000 and bottoming is that I do think there's more adoption, and I'm hopeful that more big money starts to accumulate that maybe keeps it from really doing a full 80 to 85%. But again, at least in the midterm, and my midterm 6 to 12 months, I still think there's more downside in Bitcoin.
And the last market we haven't covered yet is crude oil. This seems to have an impact on pretty much everything we purchase. And we're seeing a rally again, unfortunately, for a lot of us who are concerned about inflation. But what is your take on where that might be headed in the near future?
Yeah, so you certainly have seen it become very sticky. It seems like $95 is your base. Your high end at least was up to 130. Now your secondary high is down at 115 to 116. Right now we're trading just underneath 110. So I'm hopeful that at least we're making lower lows. So high, lower low, lower low. I'm in the camp that who knows what happens in the next week, 2 weeks, 3 weeks for oil. But I think if your outlook is 2 to 3, 4 months out, I think oil is down sharply from here. Short-term target is 85 for me. And then by midterms, I even think, and that, so some people that might be short-term, but that's more midterm for me. By midterm elections in November, I think you're at $75 a barrel. The reason I come up with that is, number one, we actually topped out on the monthly chart with that spike right here. So this is just a remarkable chart. But you can clearly see that if you connect a trend line from this low to this low and then right here, all right, and this one, by the way, is when it went negative, which was just insane. And then you take a parallel line and stretch it up, you get a perfectly parallel line that marks off this 130. So right away when we hit 130, I said, okay, it's done going up. Now you're kind of having this sticky price. But again, if you think about everything the Fed is doing by raising rates, what do raising rates do? It slows the economy. What is the war in Ukraine and supply chain having an issue? It's basically causing inflation. That means people can afford less goods. It's slowing the economy. I mean, all these things are slowing the economy. And you have to think about the demand side of oil. So if people drive less, if they fly less, if they buy less goods, there's less demand for oil, and that will cause oil to come in. So I do think that, if you have a mid to longer term, 6 to 12 month horizon, you'll see oil down significantly from these levels, even though most people will tell you. I mean, I was listening to CNBC today and everyone was like, oh, you got to be in the oil stocks. That's the only place to be. When you hear that, and I'm telling you this from experience, it's usually the time to sell into that buy pressure. So just be aware of that.